Hey, hello, folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade. I'm going to get you what you need to know before you go, and that starts out with some economic data, see how that impacts the overall markets, maybe sprinkle in some geopolitical fodder to round off the entire analysis, and then we'll talk about some option strategies that I might be implementing into my portfolio. So, without further ado, economic data across the pond we've been talking about this week is going to be pretty important data, looking at inflation, looking at how the economy is doing, all of those things. One of the things we noticed here in the United States was we got GDP yesterday, and that came in at 6.9%, a little bit lower than the expected 7%. So are we seeing this whole pullback? Now, one of the things I talked about with higher prices of, say, for instance, crude oil that we've been talking about, when it gets up into the $100 a barrel mark, that people aren't able to spend their money elsewhere in the economy. That is a crimp on the expansion of the economy, because if I can spend $5, you can spend $5, they can spend $5 differently every single time, or even $15, it feels like these days, 15 to 20 at some point. Well, if you're spending that much money extra into your tank, you can't spend it elsewhere. R&D on some of these people that have trucking firms, they're spending too much money into the gasoline. They cannot expand on other aspects of their economy. That's going to cause the economy to start to slow. I talked about that. GDP shows up yesterday. We see it come back a little bit, come backing off a little bit. The other thing we saw yesterday was the yield curve inversion. Now, let me give you guys a real quick explainer of what this means. As an investor, what we're trying to do, or a trader, is we're trying to predict what we think interest rates are going to be doing over the course of the long term, right? Well, longer duration has more risk. So you would expect that you need to command a higher interest rate for that longer duration risk. Well, what happens when we see the yield curve inversion? It means that the shorter duration yields are higher. Say, for instance, a 2-year yield is higher than a 10-year yield. That's a yield curve inversion. And what does that mean? It means that they expect a spike in interest rates in the near term, but the longer term is going to see lower interest rates. That is an expectation of a recession down the road here, folks. And that is why we're starting to see a little bit of kinks in the armor here in the overall markets. Crude oil pushing higher is going to kind of put the nail in the coffin if it continues to move higher, that we will go into a recession going forward. And that's just a product of higher gas prices. We generally see higher gas prices in the $100 barrel area. That starts to slow the economy and could possibly put us into a recession there. That said, bonds do continue to see the interest rates rise as we continue to slide here. As price goes down, that means interest rates are rising. But what we're seeing here is that the price of the 10-year is not falling, the price of the 10-year is not falling that as fast as what we're seeing here in the 2 years. So that's causing that yield curve inversion, which is a signal that the market is concerned about a recession. That said, that shouldn't necessarily affect Bitcoin, but there's a lot of ancillary things going on here with Bitcoin. Some of the things is with all of these new taxes, how are they going to tax cryptocurrencies? One of the things that they're talking about, folks, which is going to probably really change the whole scope of what the American economy looks like, is a tax on capital gains, not just capital gains, but unrealized capital gains. And what that means is that the folks can kind of choose when your taxes are going to come in, right? Now think about if you had bought here, and let's say your buy is on the low. Well, if you see the market make a nice big move, let's take, for instance, something like, I don't know why I have that, PEN. Let's look at PEN real quick. So, for instance, PEN, if we go to like a 3-year chart of this, we could see that had you bought on this low, your capital gains could have been all the way up to 142 on your unrealized capital gains, from 4 to 142. Pay taxes on that, 20% tax on that capital gains, right? Unrealized. What happens after you pay that tax possibly? And the market free falls and gives back, 3/4, maybe 4/5 of their market value. And are we going to get a tax deduction for that? No, probably not. You're not going to see that tax deduction overall just on the pullback in the markets, okay? And that is going to be a problem. Folks are going to that have the money that they're trying to tax are going to be able to figure out ways around this. And that might mean that they pull their money out of the United States is one of the fears. All right. Bitcoin, we talked about. Gold futures. One of the things I want to talk about here with gold futures, this is just amazing sometimes when this stuff happens. We talked about the support and resistance of this 193, the trend channel, the 50-day moving average. You guys have heard me talk about this stuff until I'm blue in the face. Well, what's happened yesterday with just this market alone? Well, it tested the trend channel and failed on that trend channel. We can see that. We opened right below it, made a push to the upside, but then started to fail. And we tested that 50-day simple moving average and it held like a champ. Market rallied up and was able to settle just slightly. If we can take this down here, we can see that the all-time high, the all-time high here is 1923.7, and we can see that the close is just $1, maybe 50 cents higher than that. So it was the bulls really made that effort to get that settlement above the previous day's high. That's going to make the bears a little bit more nervous as that power of the strength in that market there. The thing that just kind of captured right in between there was the thing that really caught me. And then today we're going to keep an eye on this. Are we going to be able to break above that trend channel? That would be a bullish sign there. A lot of bullish signs there in gold. So I would say risk is to the upside in gold there. Now we're seeing VIX continue to slide, but that's because we've had several days of positive gains. If we finish in positive territory for the week, that'll be I think the third week that we finished in positive territory. We haven't seen that in a very long time, folks. So that would be very that bullish for the overall markets. Now, we've had a long, very parabolic move to the upside here. Can it continue? Yes, but do I think that that is the most likely scenario here? No. As a matter of fact, I think we're going to push a little bit higher maybe, but ultimately opportunities here is to look at selling some covered calls in your portfolio. Right now, you need to be a little bit more aggressive here on these rips. Look for covered calls because I don't think that we're going to get all the way back up there to the all-time highs. We might get close, but that will be just enough to test you on your covered calls, not enough to probably have you get called away there. The risk to the downside, I think, is still here in the equities. It's all going to be about the talking heads in the markets here. And some of this economic data we get, I don't think is going to be as important as listening to some of these talking heads, seeing what's going on in the overall economy. This, what happens in China, Russia, Ukraine, still in the limelight there. All these charts are starting to look very similar. You can see we got a little bit overextended, which is what we talked about with the E-mini S&Ps. We'd probably see that make that move to the upside as it probably wouldn't have made that move to the downside. Both of those scenarios have started working out here. And then we break it down to the mini S&Ps on the hourly chart. We can see not a whole lot going on here. It's just a wait and see game on the economic data to see what's going to go on. We get crude oil inventories today. We get 2 or 3 Fed governors speaking. So it's going to be an action-packed day full of people talking their side of the economy there. All right. So Coca-Cola, a lot of markets are starting to look like this. We're looking at Coca-Cola as a topping pattern. So this is why I'm believing that risk is to the downside. I'm flipping through charts just down the line. And XLP, I think, was one that was even making a nice big top chart here, which is a little bit odd that consumer staples would start to suffer here. But we're looking at the charts. That's an opportunity for downside risk. So I would look to play this. We could start getting a confirmation, anything settling below the previous day's low or the previous days or 2 days ago high. I would say that that would be an opportunity to get involved here. So I'm looking at some opportunities to add some negative deltas to my portfolio. This week, we're doing a poor man's covered call, which is a brilliant strategy that we can make it act like the stock or the underlying with some protection. We won't have any risk to the downside. Well, we'll have some risk to the downside, but it'll be limited risk to the downside, and we will do some covered calls against that type of strategy. So I'll show you how to build that out. kind of like a strangle around a stock in the webinar. So check that out. Make sure you guys are smashing the like button. Don't forget to subscribe and comment. If you can't take that, take it easy.